Hi folks, and welcome to our video on long-term notes receivable that are zero or non-interest bearing. In this case, we have our company, say it's Clearing, and Clearing has provided environmental services to rank its customer. So now, Clearing has to make some journal entries on its books to do two major things. Number one, it has to record the note at the date the note's made. In our case, that's December 31st, 2013. The second thing they have to do is they have to make notes to journal entries to record interest on the note at the end of 2014 and the end of 2015. Now we can see in our question that the Clearing Corporation has agreed to accept a promise by Rank to pay the amount of $200,000 in 2 years' time. Because Clearing hasn't specifically stated an interest rate, they've elected to use Rank's borrowing rate, which they've determined as 12%. So in essence, they're going to charge them the same rate as the bank would charge Rank to pay interest. So what we're going to do now, in order to calculate how much Clearing would set the note up for, we're going to do a present value calculation. And we're going to set our calculator P/Y equal to 1, and we're going to calculate the present value based on a future value that we expect to get from Rank in 2 years. That's $200,000. We're going to use the same rate the bank would charge them to borrow, which is 12%. We also know that we're going to get paid this payment in 2 years' time, so there's 2 periods. And we also know that in the interim, from the date we make the note, which is December 31st, 2013, until the end of 2015, there's going to be no annual payments. The only payment that will take place is at the end of 2015 when Rank pays the note back. But in the interim, there are 0 or no payments. So if we do a compute PV, we're going to get a present value of $159,438. And we're going to set that up as the value of our note receivable. And again, in this case, because it's a service that we're offering, we're not loaning Rank cash. So in this case, we're just providing a service to Rank. We're going to have to record our service revenue in our books at $159,438. So now that we've done the entry at the end of 2013, we can set up, if we wish, a table. And in this table, we can set up calculations within the table in order to find out how much interest income or interest revenue Clearing would book at the end of 2014 and the end of 2015. So what I've done here is I set up the table, and again, it's optional. Some people might just choose to use the math approach to calculate the interest income. But I've decided to use the table just to show you how you could do it. And in this case, just going to go back here. In this case, I've got my columns set up here, and I've got the fact that at the issue date, there's no cash interest or no interest payment that's been made by Rank to Clearing. Clearing would book no interest revenue because revenue is earned over a period. The first time we would book interest revenue is at the end of year 14. And then there's been no amortization of the note. We're just setting up the note at the end of 2013. You can see we did that here at the top. And I've set up this unamortized column. You'll notice in your textbook they don't do that as a matter of course because it's not really germane to the question. We don't really need it. So when we get into the 2014 and 15 year, I'll explain why, or in the issue date, I'll explain why. And then we've got our note receivable at its carrying value. So you can see here we've set up the note receivable at its carrying value, and the difference between that carrying value and the face value is going to be the amount that's unamortized. We don't use the unamortized amounts in this column for anything specifically in our question, so that's why in the textbook the authors have eliminated it. But in any case, we'll keep it here because we know from previous courses that might be what you're used to. So now when we get to the end of 2014, we know we have to book interest revenue. How are we going to calculate it? Well, we're going to take the carrying value of the note to open 2014, which was $159,438, and multiply it by our I/Y, which is 12%, and we get $19,133. That's also going to be the amount of discount that we amortize on the note. So if we took the carrying value of the note and increased it by the amount of discount we're amortizing on that note, the carrying value of the note would now be $178,533. $178,571. Remember, with this note, Rank has agreed to pay clearing back $200,000 at the end of the 2-year period. So our note is going to grow from the present value we calculated issue date to the $200,000 amount. So we know that our note receivable has to go up in 2014 by some amount because it has to keep getting bigger, as you can see in this last column. So now our journal entry would be to debit the note. Again, it's non-interest bearing, so we debit the note receivable directly, and we're going to credit interest income or interest revenue for $19,133. If you elected not to do a table, you would just do it math-wise. Take your opening value, your opening carrying value for 2014, multiply it by 12% to get $19,133. So now that gives you your entry. So now what about at the end of 2015? Well, two things have to happen. The first thing we need to do is we need to book our interest revenue or interest income for the year, and then we also have to extinguish the note because Rank presumably would have paid back clearing $200,000. So let's look at how we're going to calculate the interest on the note. Well, we already know that the opening carrying value of the note that opens 2015 is $178,571. So we can take that and multiply it by 12% in order to get $21,429 as interest revenue. And that's the number we've got here. We can also calculate it math-wise without a table by taking the opening carrying value of the note at the date it was made, adding in the amount of interest revenue that we booked, which also increased the value of our note. We said previously to $178,571. So take those two amounts and multiply them by 12% to get $21,429 as your interest income or interest revenue. Now you'll notice at the end of 2015 that brings us up to $200,000. How come? Because $178,571 plus this $21,429, which we calculated here or here within our table, however you did it, right? That's going to give us, when we add this number to this number, it's going to give us $200,000, and that's the value at which we have to extinguish the note. Now, the question also asks you to talk about classification. So at the end of 2014, where would that get classified? In our case, it would be classified as a current asset, and you can set it up as $200,000 less the unamortized discount of $21,429, which we have here in this column, if you chose to use an unamortized discount column. All right, and it would be current because don't forget, the note expires or it's due at the end of 2015, and from the end of 2014 to 2015, that's a year, so it's current. Now, the last part of the question asked us, it said, if an appropriate market rate of interest for the note receivable was not known, so if we didn't know the 12%, how should the transaction be valued at the date the note was made, which was December 31st, 2013? Well, if we didn't have that 12% rate that we used up here, we wouldn't have been able to calculate this present value of $159,438. So we would have had to know the fair value of the services that we offered. So say, for example, the fair value of our services had been $175,000. If we had no idea or no preconceived idea of what interest rate we would like to charge them, or we didn't know their incremental borrowing rate, them being Rank, then we would just set the note receivable and the service revenue up based on what we would have billed any other client for similar work. And if that, say, was $175,000, that's how we'd set it up at $175,000. So the only other thing we could have done here was to use the fair value of the consulting services that we, as clearing, provided to Rank and value the note receivable and the service revenue at December 31st, 2013 based on that amount. So we wouldn't have calculated this amount. We would have just used the fair value of the services that we performed. So that concludes our discussion on this problem on long-term notes that are non-interest bearing.